So, have you ever looked at your receipt and just been baffled? A huge global event happens, it's all over the news, and then nothing. But then, months later, the price of something that seems totally random goes up. It feels like there's no connection, right? Well, there is. And today we're going to pull back the curtain and trace that hidden journey a price hike takes, all the way from that initial shockwave right to your wallet.
This is the big question, isn't it? You hear about some major disruption on the other side of the world, and then you kind of forget about it. But almost a year down the road, suddenly your car tires or food containers are more expensive. It feels completely disconnected. But believe it or not, there's a direct and surprisingly slow chain reaction that's been happening behind the scenes the whole time.
And this timeline just lays it all out. We're not talking about a quick jump. This is a slow burn. The entire trip, from that initial shock to the price you actually pay at the store, can take anywhere from 9 to a whopping 18 months. It's like an invisible wave moving through the global economy. The real key here is understanding what on earth is happening during that lag.
All right, let's get into it. To really get a handle on this delay, we're going to follow the trail of one single event, a sudden spike in the price of oil. Just picture it as the very first domino to get knocked over in a really long line of dominoes.
So here's how that domino chain actually works, broken down into 5 key stages. It all kicks off with that raw energy price shock. We're talking crude oil, natural gas. That happens fast, within weeks. But you and I, we don't feel it yet. Companies have inventory, they have long-term contracts. The first real handoff, the first domino to hit the next, happens about 1 to 3 months later. That's when basic chemicals get more expensive. From there, it just keeps rolling, to materials and parts, then to the finished goods from brands we all recognize, and finally, after maybe a year or even more, it lands on the store shelf.
Now this is where it gets really interesting. These words, ethylene, propylene, they sound like something from a science textbook, but these are literally the building blocks of almost everything around us. Ethylene, that becomes the plastic in, well, everything. Propylene, that's in your food containers. And that ABS resin, that's the sturdy plastic casing on your electronics from companies like Sony and Panasonic. The price of oil is baked into all of it.
Okay, so you might be thinking, hold on a second. These are gigantic, multi-billion-dollar companies. Why can't they just eat the cost? Take the hit on their raw materials and protect us, the consumers? It seems like they could, but when you look at the financial reality of the chemical industry, you see a totally different picture.
And here's the answer. It's shockingly simple. A 5 to 10% operating profit margin. That's it. That's the wiggle room they have. So when your main ingredient, something derived from oil, suddenly skyrockets by 30 or 40%, there's just no room to absorb it. It's not a choice to pass that cost on. For them, it's about survival.
And look, this isn't just some economic theory. We all just lived through a perfect, real-world example of this. The war in Ukraine triggered a massive oil price shock back in 2022. And then, right on schedule, about a year later in 2023, what did we see? Higher prices for food, packaging, electronics, even brand new cars. The dominoes fell exactly like the model said they would.
But wait, the story doesn't stop with oil. There's another kind of inflation quietly working its way through the system. It behaves a little differently, but it's becoming every bit as important. And that's the inflation of metals.
So here's the main difference you need to know. Oil inflation is broad and shallow. Think of it like a flood. Because energy is used to make almost everything, a price hike raises all boats, just a little bit. Metal inflation, on the other hand, is specific and strong. It's more like a laser beam. It doesn't hit everything, but for the industries that rely on those metals, the impact is intense.
And which industries are we talking about here? Just the most important ones for our future. Your smartphone is packed with tiny amounts of gold and silver. And the whole green energy transition, it is literally built on metal. An EV from someone like Toyota or Tesla needs about 4 times more copper than a regular gas car, and that's before you even get to the lithium and nickel in the battery. Our move to an electric world is also a move to a metal-dependent world. So, when the price of these specific metals shoots up, companies making our favorite gadgets are in a really tight spot. If they just jack up the price of a new car or a new phone, they risk scaring customers away. So they often turn to a different strategy, a much sneakier kind of inflation. And that sneaky tactic has a name you've probably heard: shrinkflation. We usually think of it like getting a few less chips in the bag for the same price. But in the world of high-tech manufacturing, it takes on a much more subtle, almost invisible form.
And this is what it actually looks like in practice. It's an electrical cable that is microscopically thinner just to save a tiny bit of copper.
It's a slightly less generous layer of gold plating on the connectors inside your phone. Or maybe it's a new device that just quietly has a smaller battery capacity than last year's model. You're paying the exact same price, but you are, technically, getting less. It's a price hike in disguise.
So let's pull the camera back and put this all together. When we look at the big economic picture of the 2020s, we're staring at a brand new and pretty challenging reality. You could say we're living in an era of triple inflation. It's really a battle on three fronts. We've got that broad, shallow inflation from energy costs hitting a little bit of everything. At the exact same time, we have that specific, strong inflation from metals driving up the cost of our tech and green infrastructure. And of course, piled on top of all that is food inflation. It's this perfect storm, this combination, that makes the price pressures we're feeling seem so relentless.
And that brings us to what might be the single most important thing to take away from all this. Raw material inflation starts its journey in complete silence. It winds its way through the supply chain, passed from one business to another, totally hidden from public view. The very last person to find out about it is us, the person standing at the checkout counter.
So the next time you see a headline about oil prices shooting up or a shortage of copper or lithium, you'll know it's not just some abstract number on a market report. It's the first domino tipping over. Which leads to one final question. Knowing what you know now, what quiet costs put into motion months ago are already silently making their way to your next receipt?